Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to talk about a very interesting company that has outperformed the S&P 500 the last 5 years, has a dividend streak of 17 years without a reduction. Hedge funds have increased their holdings last quarter, and the dividend growth of the last 10 years is 18%. So if you're interested, enjoy this video, give it a thumbs up. As always, please remember this is not financial advice. This is just me sharing. If you are new to my channel, hopefully by the end of this video, you'll like and subscribe. And don't forget to hit the notification bell so you don't miss out on any videos that I put out. With that said, let's take a look at this company. So the company I'm talking about is Pool Corp. The ticker symbol is POOL. This is a company that is leading the world in distributor of swimming pool supplies, equipment, and related outdoor products. So you can see here, they're pretty much worldwide. From the map you can see. Then you can see a little bit more, some of their brands here. So it was added in the S&P 500 on October 7, 2020. Now if we go to some of the presentation, you can see their profile. #1 worldwide distributor of pool related products. Check out the net sales from 2016 to 2021, 15% CAGR, and then you can see some of the highlights over here. So what I really like about this is, you know, if you look at it, connecting lifestyle, the future of outdoor, they have their own app with all these other integrated things like the security system, backlighting, water chemistry. Pretty interesting. So you can see a little bit of their mix, their business mix. You can see your customer profile, you can see network channels to market. Let's take a look at Simply Safe Dividend. Based on their dividend safe score, they rated at 69, which is safe. The dividend yield is 1.27. It is considered a large cap. Now if we look at the key metrics, you can see payout ratio is 18%, forward payout ratio is 22. During the recession, they've maintained their dividend. If you look at the dividend growth, you can see here the last 10 years 18%, last 5 years 20%, and then the latest is 25%. And then if you look at the chart, you can see slow upward trend with 11 years of consecutive growth and uninterrupted dividend streak of 17 years without a reduction. For your payout details, you get paid quarterly in the months of March, May, August, and November. Annual payout would be $4 per share, which breaks down to about $1, and then you got 80 cents. If you look at the dividend yield, it's higher than the 5-year average, and then your PE ratio 11 for the discretionary, and then 17 for those stuff. You are getting it based on the 52-week low. You can see right here 311 is the low. At the time of this video it's at 315. The high would be 577. And then you can look at some of the data in here. So look at the sales growth, total sales in billions, return on invested capital 32% the last 12 months, return on equity 74 the last 12 months, and then you got your operating manager and net to debt EBITDA. Now let's take a look at Yahoo Finance. So in the 5-year, based on comparison with the S&P 500 versus Pool, you can see Pool Corp has been beating the S&P 500 the past 5 years. Now if you look at the 2-year one, pretty much almost the same. Yeah. Now if we swing to who are the top institutional holders, you can see Vanguard has these months of share, followed by BlackRock, State Street Corporations, and then you got all these other ones. Yeah. Now let's swing to TipRanks. Based on the hedge funds, they have increased their holdings, as you can see here. Confidence signal is positive. Now if we look at the stock analysis, you can see Smart Core has 8, which is outperformed, and then you can see these positives and all that stuff. Now if we look at the price target, is in the high of 465, the average of 421, and then the low of 398 with a 33% upside. Their analysis rated as moderate buy, which is 2 buy and 3 holds. Now if you look down through some of the analysis forecasts, you can see pretty good amount of upside. You got guys telling that they feel that it's a 47% upside, 43% upside. This one right here is 74% and then 63. Yeah. Now if we go to NASDAQ, based on their analysis, there's 13 of them. They rated as a buy. And who are they? You got like Goldman Sachs, Edward Jones, Zach Research, and then their analysis would be in the high of 465, average of 421, and the low of 398. Now if we look to Seeking Alpha, you can see 10-year performance plus 634. So pretty solid for the last 10 years. Now if we go to bar chart, based on their analysis, price target is in the high of 550, medium target is 431, and then you got your low of 370, and then it's a rate analysis rating of moderate buy. So based on the past 3 months, it's still moderate buy. Currently it's a mixture of 5 strong buy and 6 holds. Now if we swing to Stock Rover, based on their analysis, they rated as a buy. There's 11 of them, and it broke down to about 5 strong buy and 6 holds. Now if we go to comparing the industry versus the S&P 500, you can check this out. 3-year return 63% versus the S&P 500, which is 28%. 5-year return 206% versus 58, and then your industry is 84. Now let's swing to simply Wall Street, based on share price and fair value. Their fair value rated as 468, and then current is 315, 32% undervalued. And then you can see, based on the company overview, here are the positives, and then the risk is earnings are forecast to decline by the average of 1 per year in the next 2 years. Debt is now well covered by operating cash flow, high level of non-cash earnings. Now if we swing to Robinhood, you can see the 1 month performance is negative 9%, 3 months is negative 8%, and then for the year it's been down 29%, and then for the week it was up 1%, and then the sell-off today, which is negative 4%. So, and then based on Robinhood's analysis, they rated as buy of 54%, a hold of 45%, and then a sell of 0. You are going to get the earnings on October 20, which is the pre-market, so we'll see how that goes. So what do I take for this? I think it's a pretty solid company. I think it is a good buy in my opinion, but for me, I'm not looking for a company like this. I much prefer the companies like Johnson & Johnson and Walmart and stuff, right? Solid companies right now because of the uncertainty, in my opinion. I'm not sure because how this company is going to perform based on this the situation that we're in right now. So I'll definitely put this on my watch list and see from there. All right. Thank you so much for watching. There are also other videos that you can kind of check out with great dividend companies. Hopefully, those of you that haven't yet subscribed, subscribe. Really means a lot to me. All right, guys. Thank you so much. Please be safe out there. Stay cool. Keep investing. and I'll catch you guys in the next video, right? Take care. Aloha.